About 24 seconds away from the opening bow this morning. Good morning to you. We have a lift on the S&P 500 by 0.9%, on the Nasdaq 100 by 1.6%. Tick for Alphabet, tick for Microsoft. Looking ahead to Facebook a little bit later, then on to Apple and Amazon tomorrow. That's the price action. Switch up the board and get to the bond market. Going into the Fed, yields look like this. We're down 3 or 4 basis points on a 10-year, more curve inversion. Your 10-year right now, 277.21. Euro dollar 101.42. Positive there by about 1/4%, and crude higher by $1 and about 50 cents, up 1.6% to $96.50. We're about 15 seconds into this. We can get you some movers. We can welcome back Katie Greifeld. Hey, Katie.
Hey, John. Well, we're finally in the heart of earnings season, finally getting some good news. You did have Microsoft post its first earnings miss since 2016, but a pretty rosy outlook, giving the stock a lift this morning. Shares higher by about 3.5%. Alphabet, a similar story there. It missed estimates, but ad sales were a bright spot. And remember, we were a little bit nervous after Snap last week. So you're seeing a relief rally there. And broadening out from tech, you have Boeing catching a bit as well. It reported that it reversed its heavy cash burn. It actually generated $81 million in operating cash flow last quarter. Analysts were expecting another big loss there. That's why you see the stock up nearly 4% right now. And finally, we do have T-Mobile also popping after a beat and a raise. Subscriptions topped estimates, and T-Mobile also raised its subscriber growth forecast for a second straight quarter, John.
Katie, thank you. We've got a move of about 5% on the likes of Google. Alphabet up by 4.5%. Both companies, Alphabet and Microsoft, reporting double-digit revenue growth. The challenging macro conditions, Microsoft highlighted many of them: unfavorable foreign exchange, extended production shutdowns in China, take your pick, reduction in ad spend, the ongoing war in Ukraine, tons of it. Does this set the tone for what we could hear from Apple, Amazon and Meta still to come? Let's get to Kelly Lines for more. Hey, Kaylee.
Hey, John. Well, it's certainly setting the tone for the broader market today because, of course, these are two giants. They're the second and fifth largest weightings in both the S&P 500 and the Nasdaq. So no surprise, given that the stocks are moving higher off the back of these better than feared results, you're seeing a nice lift for the broader market as well, with the Nasdaq 100 up about 1.6%. Now, of course, Microsoft, as Katie alluded to, the optimism is coming from stronger than expected guidance. It expects revenue and operating income to grow by double digits again in fiscal 2023. My producer Pete was asking me earlier, how can a company that large continue to grow in double digits? It's really quite remarkable. Now, for Alphabet, you did have revenue coming in line, advertising spending hanging in there, which could be a signal that A, Google as a larger company is just better positioned than smaller rivals like Snap and Twitter to withstand a pullback in marketing spending, and B, it's noteworthy that the strength came from search ads, not from YouTube, which is more socially oriented. On YouTube, ad revenue was actually only up about 4.8% relative to the near 12% year-on-year growth that Google search saw. And it's the weakness in social ads in particular that is worth paying attention to as we look ahead to Meta's results after the bell today, because they're dealing not just with a slowdown in advertising broadly, but also competition from the likes of TikTok and those privacy rule changes on Apple that have dogged them for some time. Now, we're gearing up for maybe a big move from Meta, about 12.5 percentage points plus or minus after the bell, even though that's a little bit less than the average move is what is implied by options at this point. And of course, we'll also get Qualcomm after the bell, then Apple and Amazon coming on Thursday. And Amazon, remember, is a growing player in the ad space. So it'll be interesting to see what the read-through is to that company as we also look for clues around the consumer, especially in light of the news from Walmart yesterday, Sean.
Kelly, thank you. Busy 24 hours coming up. The first 3 minutes of this session look like this. We are positive by 0.8% on the S&P. Communication services up by 1.9%. The strength where you'd expect the strength to be. Information technology up by 1.66%. For Wall Street, the rate hike bets are in. The consensus is 75 basis points. There was just one. I saw one looking for 100 basis points. It's been Nomura front and center for a long time now. Mike McKee joins us for more. Hey, Mike.
Good morning, John. Well, you get this interesting confluence of earnings and a Fed decision that's pretty much priced in. And you may not get a whole lot of moves today, but we do have economic data over the next 2 days that could move the market's anticipation of what the Fed's going to do in September. Now, a lot of people have been looking at the 210 yield curve. Jay Powell says he prefers the 3-month, 18-month forward curve, and it has gotten a little bit more negative, a little bit flatter after the data today, and it's been on the short end that moved it, the blue line there. That's because the data were good, and it may mean the Fed does more in the long run. But we'll ask him about that. Does this point to recession, the fact that we've gone so deeply negative on, well, we're almost negative, not quite there yet, on the 318. Now, here's what the markets will be looking for after this week. You get July payrolls, and you get 2 CPI reports and a PCE. That last CPI report comes after the Fed's in blackout, so we won't know what they think of it. But these will give us the clues as to what the Fed thinks needs to be done. Is growth too strong? Is growth too weak? Is inflation still too strong or still coming down? And the way to track all that, and you can do that starting today and this afternoon, is by following trading in Fed funds futures, of course. And you can see here sort of an active billboard of what's happening. At this point, the market sees a 60% chance of rate increase, a little bit between 50 and 75 basis points for September, but they really back off, and by the end of the year, they're not looking for much of a move at all. That would be a quarter point move. So let's see how that changes as we get the data the next 2 days, and then the jobs and inflation data going forward.
Mike McKee is not in an ivory tower. We're looking forward to his questions in that news conference coming up a little bit later. Mike McKee there down in Washington, D.C. Morgan Stanley's Lisa Shannon has got things to say. Here's the quote. A modest uptick in unemployment claims from historically low levels is unlikely to end the Fed's mission if inflation remains well above their 2% target. The latest bear market rally, in our view, is full of wishful thinking. Profit forecasts still need to be reset. Lisa, I'm pleased to say, joins us right now. Lisa, let's start with that line. The latest rally is full of wishful thinking. What are we wishing for?
Kicked off the segment, focused on technology earnings is probably, one of the hearts of the problem. For investors who, think that this second quarter, is the signal of an all clear, I just don't think that they're looking at the data. If we look at the rollover in PMIs and we look at the rollover in the Fed regional surveys, we know that the overall economy is beginning to slow and slow pretty provocatively. When that happens, we know that year-over-year profit growth really slows, if not outright contracts. And so, this is a market that seems to have forgotten, at least on the equity side, that Fed policy operates with leads and lags. And right now, we're sitting in front of a very aggressive tightening cycle where from where Fed funds is right this very moment, we're poised to double between now and December, and that's going to have pretty material reverberations on demand as we get into 2023.
Elisa, there is this belief that we are going to have seen peak Fed hawkishness, and that's behind us. Ian Shepherdson of Pantheon wrote this. He said the Fed is boxed into a 75 basis point hike today. The latest inflation data unlikely or will likely keep the talk hawkish. Things will change by September, he went on to say, but Chairman Powell can't claim victory yet after the transitory debacle. Are you saying we've already unleashed these negative forces through Fed tightening from what we've done already alone? Are you at the same time acknowledging that we could get this Fed slowdown, Fed pause, pivot, whatever you describe it as, later this year?
I'm not convinced that we're going to get a Fed pivot. I've long been in the camp that says Fed credibility has taken a severe beating here. And I think it's going to be very hard, even if inflation halves from where we are today, which would put it below 5%, it's going to be a hard argument for Chair Powell to say that 4.5 is close enough in economic terms to meet his 2% Fed target. So this is a Fed, whether they like it or not, and whether markets like it or not, is probably going to have to quote unquote overdo it to regain credibility with the public, which is, it seems like that's the audience that Powell is now playing to.
Elisa, what is overdoing it? Can you put a number on that? What does that look like?
Sure. So I think, a lot of the wishful thinking, as we talk about, is this idea that with this 75 basis points today, we're going to be at quote unquote neutral, the neutral rate of interest in which we're neither stimulating nor being contractionary. And that's been estimated about 2.25 to 2.5%. Our guess is that the Fed funds rate is going to have to blow through that by at least another 100 basis points, which puts us definitively into quote-unquote contractionary policy.
So Lisa, we've got a tighter Fed. You think we need a profit reset. You're expecting more weak data. Let's start here and finish here. Where do you expect those profit forecast revisions to be concentrated? Is it broad-based across the market or concentrated somewhere particular?
Yeah, so look, our sense is that this is going to be pretty broad-based, but where, a lot of our concern has focused is on some of the companies where expectations just have remained, in our humble opinion, unrealistic. Again, what we're seeing with the numbers in Google, Microsoft, obviously, impressive given maybe a particular negative sentiment, but not great overall in the context of these companies. These companies have enjoyed extraordinary demand growth over the last couple of years and peak operating margins. And those are just things that are unlikely to be sustainable in a world where the dollar's still so strong, where we're going to see recession outside the United States, where we potentially are going to get close to having a recession here in the U.S. I just, think that it's going to be a miracle if these guys can make the numbers that are currently forecast for them.
Lisa, awesome to get your view on things. As always, Lisa Shallett there of Morgan Stanley Wealth Management. Your equity market positive today, at least, that 1% on the S&P and the Nasdaq by 2 percentage points. Coming up, rising cost pressures weighing on corporate earnings.
The second quarter was our biggest challenge when it came to inflation, but also to disruption of supply chains. We had a huge challenge to mitigate the cost inflation.
We'll take a look at some of the miners. Up next, we'll be catching up with Rio Tinto CEO Jakob Stausholm for an exclusive conversation. That's next. This is Bloomberg.
The trends that companies are talking about, too much inventory, sales are slowing, margins are shrinking, labor costs up, commodity costs up, transportation costs up. Worker productivity hasn't been this bad in something like 70 or 80 years. So the near-term trends are not good. Third quarter likely to be worse.
Busy week of earnings keeping markets on edge as firms warn of slowing growth and surging energy prices. Rio Tinto cutting its dividend in half as miners face a triple burden with dragging commodity prices as well. Kaylee has more. Hi, Kaylee.
Hey, John. Yeah, Rio Tinto down in the London trade, and the ADR is down about 3% in the first few minutes of the U.S. trading as well. It really goes to show you what a difference a year makes, because a year ago we were talking about surging iron and copper prices due to a demand picture that really couldn't be met with supply. Now we're talking about global recession and property turmoil in China, which weighs heavily on iron ore demand in particular, and that represents the lion's share of Rio Tinto's business. When you add in inflationary pressures and ballooning operating costs, what you end up with is a squeeze of profit margins. And when you put it all together, first half earnings for Rio Tinto came in at $8.6 billion. That missed the average estimate and was down substantially from the $12.2 billion, the record it pulled in last year. And as a result, the dividend is getting cut in half, as you said, John, only $4.3 billion. That's only about 50% of underlying earnings. But this isn't a unique Rio Tinto problem. This is really true across the mining and materials space. Growth concerns, lower prices, higher costs are affecting other companies as well. We saw that borne out with Newmont earnings earlier this week. It plunged due to a surge in cost. Freeport-McMoRan coming in a little light as well. It's just a tough space to be in right now, John.
It's difficult. It's tricky. Kaylee, thank you. I'm pleased to say that joining us now for an exclusive conversation is the Rio Tinto CEO, Jakob Stausholm. Jakob, let's start right here. And thank you for being with us, by the way. You've halved your dividend. It's at 50% of underlying earnings. Can you help us set expectations for the rest of the year? Yeah. Is that the kind of ratio investors should expect?
Yeah, well, there's two aspects. First of all, it is lower compared to first half of last year, but we just have to remind ourselves that was an all-time high. Iron ore price was trading above $200 per ton. If you compare our results here, for example, with first half in 2020, it's much, much higher. So actually, historically, it's a very strong results we're coming out with. We have 34% return on capital employed, the $8.6 billion underlying earnings, and we pay out $4.3 billion of interim dividend. We always follow a policy of payout ratio, and we normally pay out around 50% in the first half, and that's what we have done. And you know what? The $4.3 billion actually represents the second highest interim dividend ever. So it's what you compare against.
It's a high bar. I appreciate that, but things are getting harder, as you know. Lower prices, higher costs, it's never a welcome development, sir. Are you seeing any of those issues ease? Are they getting better? Are you bracing for it to get worse?
No, absolutely. Look, the world is in a very volatile state. When we started the year, we had not expected that there would be a war in Ukraine. You keep on getting new disruptions, and lately we have learned that particularly the Western world has much, much more inflation than anyone would have predicted. Those represent challenges in the short term, but long term for a miner, there is an enormous need for our products, and the energy transition that is happening now is stimulating our demand. But how do we navigate in the short term? And I would say to you, we actually sell more than half of our products into China, and China does not have inflation. They have had some challenges with COVID lately. We have all had challenges as we went along, but they, given the fact that they don't have high inflation, they can probably easier stimulate the economy, whereas the Western economies somehow will have to find a way to weed out the inflation.
Well, right now, as you know, they've got a nominal growth problem. They might not have an inflation problem, but they've got a growth problem for sure. We can see the lockdowns on and off. You see it in Wuhan, another 1 million residents locked down. You've got a fantastic line of sight into the Chinese economy, far better than me and far better than the other guests I speak to. What does demand look like right now? Is it improving? What's your sense of things at the moment?
Yeah, look, it has not been a strong demand in the first half, but we are convinced, and it's always difficult to say how long time will it take that the Chinese economy is being stimulated, and that means that more growth will come in the second half. Is it next month, or is it 3 months or 6 months down the road? It's always difficult to say. I try to avoid predict the very short term. I'm not sure anyone is capable of doing it, but we remain convinced that the Chinese have got the measures and the desire to stimulate their economy.
You mentioned the war with Ukraine and Russia. I recall you sold your last coal assets in Queensland back in 2018. There was always this feeling that once that door had closed, we were never going to reopen it again. And I just wonder, when you think about this ESG transition, is ESG as we know it, based on the reality check of the last 12 months, is ESG as we knew it, is it over? Is it dead?
I think the opposite, because what has happened over the last year is that the price of gas, the price of oil have gone up, and that basically means that it's become more attractive to invest in renewable energy, because for Rio Tinto that use a lot of gas, a lot of fuel, if we can replace that with renewable energy, we have a better case now in a high price scenario than we had before. No, I actually think that what the world needs in order to make the energy transition or decarbonize is an energy transition, and I do believe that if anything we will start doing more solar, more wind, etc. And certainly we are doing that because we have a target of halving our carbon footprint by 2030.
So you don't see coal making a comeback anytime soon?
Look, I think it's the wrong way to focus. The world needs energy, and if it lacks energy, then they will pull a little bit harder on coal. But the long-term trend is about getting enough renewable energy in place, and I see it happening. Back to China. China is investing enormously in renewable energy, and right now for us we are actually taking off with some really big renewable projects in Australia as well.
So Jakob, let's finish here. I've spoken to several of your predecessors. I remember Sam Walsh had to inherit the mess, the commodity bust after the big boom we saw in China. Jean-Sébastien Jacques had to shift from volume to value. How do you think you're going to define your approach in this moment? How would you characterize it?
So look, I really believe it's an amazing company with amazing assets. I'm very keen on working on the cultural development of the company, unleash the full potential of all our people, all our leaders, and future-proofing our assets, and that means also decarbonizing our business. We have a big carbon footprint, but we can see a path forward. The products we're producing today are even more needed for the transition, and they're much needed after the transition as well. So I really think on the very long term with Rio Tinto.
Jakob, wonderful to catch up with you, sir, and hopefully this is a part of an ongoing conversation about what you're seeing of the business, and particularly in China, which we're all trying to get visibility on at the moment. Jakob Stausholm there, the Rio Tinto CEO. Coming up, your trading diary, busy couple of days coming right up, including the Fed decision and some big megatech earnings. All of that up next. I think it's fair to say that Snapchat is not a bellwether for ad revenue in America or for that matter worldwide based on what we saw from Alphabet ad revenue overnight. That's giving the Nasdaq a lift. The Nasdaq up by 2.3%. More a sigh of relief according to many of you than any massive beat of a low bar. Equities up by a little more than 1% on the S&P 500. Yields coming in on a 10-year this morning. Going into Chairman Powell's meeting, we're down 4 basis points to 276.48 on a 10-year. That's the price action. Here's your trading diary. A Fed rate decision coming up at 2 p.m. Eastern, followed by Chairman Powell's news conference. Then Facebook. I'm not going to call it Meta, just can't bring myself to do it. After the close, a little bit later. US GDP and jobless claims tomorrow morning, plus more earnings from Apple and Amazon tomorrow after the close. We round out the week with PCE and the University of Michigan Consumer Sentiment Survey. Looking forward to that, and some data out of Europe too. From New York City, I'll catch you a little bit later at 1:30 Eastern Time for the Fed Decides with my colleagues Tom Keene and Lisa Bramitz on Bloomberg Surveillance. We'll take you through to the news conference and out the other side of it. From New York City, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, July 27th. Here are the top market stories that we're following for you at this hour. It's Planet earnings. Results stream out. Tech outperformance. We have you covered from the C-suite with the CEOs of Rockwell Automation and T-Mobile, plus Visa's chief financial officer. All right, 75 bips. Then what? Markets count down to the Fed decision and Powell's press conference. Another big hike's a done deal. The question is how the Fed looks at the recent growth slowdown. And you got lockdowns in China, strong dollar, higher yield. It's a recipe for emerging market pain. We're going to speak to the legendary investor Mark Mobius, Mobius Capital founding partner. From New York, I'm Alex Steele. My co-host in London, Tom McKenzie. Guy Johnson is off today. Welcome to Bloomberg Markets. Tom, I feel like with the earnings here in the U.S., what we're learning is that the consumer is spending, but what they're spending on and the price that they'll pay for it, that's what's really changing.
And so many of our guests as well here in Europe talking about the ability, the need to focus on those companies that can pass on these prices. You're seeing that with the earnings here in Europe from the likes of BASF, of course, a major industrial power based in Germany, but also some solace from some of the investors out there about what we're seeing in the banking earnings here in Europe if you put the idiosyncrasies of the Credit Suisse story to one side.
Yeah, fair enough. We will definitely get to in the 11 o'clock because that's a fascinating story. We do the latest housing data here in the U.S. and Tom, honestly, it's no surprise. We have pending home sales down almost a whopping 20% on a year-on-year basis. Month-on-month, it's still ugly, down 8.6%. You also had home sales revised lower for the previous month in May. So again, the latest read on housing, and it's ugly and it's painful as those higher interest rates start to eat into the demand. Yeah, it's still a supply story, but now the demand story comes into play.
Yeah, those high mortgage rates, of course, on the back of what we're seeing from the Federal Reserve, above 5% stateside now. Talking of which, the FOMC, of course, that rate decision due out at 2 p.m. New York time today. The central bank is expected to hike rates by 75 basis points, which takes us to our question of the day. 75 basis points. Then what? Joining us now from Washington is Michael McKee, Bloomberg International Economics and Policy Correspondent, of course. Mike, so we get the 75 basis points. That's the consensus today from the FOMC, but it's the guidance we're going to be looking at and where that leaves Jay Powell and co. as they look at somewhat softer data stateside.
Yeah, unfortunately, Tom, this is like, as I said earlier this morning, a sort of a three-day economist's Woodstock, but unfortunately, the Fed is the opening act because the real numbers that are going to give us an idea of where the Fed is going to go next come over the next couple of days when we get the GDP report tomorrow and we get the spending and inflation data on Friday. The problem for the Fed at this point is they've got two lines they have to follow and decide which one is more important, growth or the idea of inflation continuing to rise. And at this point, it looks like inflation's going to get the nod, which would suggest a stronger Fed response going forward. We got some strong data today, but where the Fed goes from here, they're going to try to keep their options open.
So, Mike, looking at the market, we're in a really weird place for when we're looking at a 75 basis point rate hike in a Fed that's focused on inflation. You're looking at equities higher, you're looking at yields lower, and you're looking at a modest lower dollar today, although the trend is a different story. That's a really weird thing to have to go into a Fed meeting when you're looking at a market that seems to be already pricing in a more lenient Fed down the road. How do you think Powell's going to address that?
Well, to the extent he's directly addressing it, he would probably just say that the Fed is committed to ensuring that inflation gets back to its 2% target. They want people to believe that. Now, the markets started pricing that out in the last couple of weeks after the strong CPI numbers, and we saw some weaker growth numbers. Tomorrow, if the GDP report is affected by today's strong durable goods and trade numbers, then we'll probably see a little bit of that come off. The Fed doesn't know exactly what's going to happen. It's 7 weeks until the next meeting. So I don't think they're going to push too hard one way or another. They'd like to leave it ambiguous.
Yeah, market's going to love that. Mike, thanks a lot. Looking forward to your question. For those of you who don't know, his question is the must-watch question at the presser. Bloomberg's Michael McKee. So let's broaden out the question. 75 bips? Then what? Want to ask Karen Karnal-Tambor, co-CIO of Sustainability at Bridgewater Associates. She joins us now. She's one of Bridgewater's foremost experts on macroeconomics and FX markets. Karen, 75 bips, then what?
Great question. Well, at this point, the 75 bips are very much already discounted in the markets, right? And if you look at the last couple months, you've had some of the fastest rate of discount tightening we've ever seen. And it flows through to economic growth before the Fed actually does it, because it starts getting into pricing, starts being expected. So at this point, what we know the then what of what's coming next, which is growth is slowing. Growth has already slowed pretty meaningfully by our measure. It's probably pretty close to zero, and it will go negative. And the then what is the Fed keeps tightening, at least till year end. I'd be surprised if they don't keep tightening as much as they're sort of priced to do. But then what markets tell you is that what the Fed is going to do next is actually start easing in only 9 months. And that seems pretty unlikely to me. I think what's the then what is we're going to see growth slow. That's going to start being painful and unpleasant. And the Fed is going to find itself in this tough bind where it simply can't achieve both its mandates at the same time. It has to either tolerate weaker growth than it would like because it's trying to fight off inflation, or tolerate inflation it doesn't want because it doesn't want to engineer too deep of a contraction.
So Karen, there's that trade-off then that we're facing, that the Fed is ultimately facing when it comes to the first part of 2023, in your view. What does that mean for equities then, that as Alex has pointed out, have rallied pretty strongly, of course, over the last 30 days or so, as the FOMC faces up to that conundrum?
Well, when I look at equity pricing, what I basically see, which is highly unusual relative to the last 100 years or so of what we've seen in markets, is that more or less the decline in equities has just been a reflection of higher discounted rates by the Fed. And so equities are a set of earnings into the future. You discounted them back to today. And if you have higher rates, the value has to fall because now you're discounting it back with a higher rate. Almost the entire decline is that. You see almost no change in analyst earning expectations. You have almost no change basically in the cash flows people actually expect. So what that's telling you is equities, as much as it hasn't been a great ride for investors in 2022 so far, are so far discounting almost a Goldilocks scenario where you have barely a recession, barely anything happen, and yet inflation magically gets under control. So my view is equities still have room to fall to reflect the fact that it's going to take a much deeper recession to actually get inflation under control. And even if the Fed, backs off a little bit and gets scared off by how deep the contraction is, over time they're going to have to do it, and they're going to have to engineer a slowdown that's more severe, and that's just not priced into equity markets today.
What about the bond markets? I'm looking at WIRP, and to sort of echo the conundrum that you're pointing out the Fed's going to get itself into, we're looking at rate cuts now starting in March and then continuing. Is the Fed going to be able to do that? And what's the bond market telling us?
I think the bond market is basically telling us something that is pretty implausible on the inflation side. If you look at what's priced into tips relative to nominals of what will happen to inflation, break-even inflation has a very, direct arbitrage relationship to what will CPI print. And it's telling us that CPI prints are going to normalize very quickly. In other words, the Fed is going to be very successful, very fast with the tightening it's going to do and bringing inflation back. And at the same time, it's going to be so successful it can just start easing again in early 2023. To me, what's likely to happen in the bond market is, in the very, very near term, the tightening is probably, going to happen as expected. Maybe the Fed will even go a little bit slower because they'll see a contraction that's bigger than what they expect. But once you go a little further out, rates seem implausibly low. Either the Fed will need a second tightening cycle at some point, which is just not priced in because inflation will prove stickier, or they won't do that tightening, in which case inflation will be rising and the CPI prints will just be much greater than is priced in, because I just don't believe CPI can magically come down to, exactly the Fed's desired level as the bond market's telling us without any kind of sustained tightening or really hurting the economy.
Karen, what's your read on households, the strength of household balance sheets as that inflation starts to take its toll?
I think household balance sheets are extremely strong coming out of the period of stimulation that we've seen. And so from a level perspective, the type of stimulation we did, what we've called monetary policy 3, or the combination of printing money and literally sending people checks, healed household balance sheets, very importantly, across the whole income spectrum. So, lower income, middle income, everybody really got checks and were able to heal their balance sheets massively. And the growth in wealth was, pretty significant across the whole spectrum. That said, the turn has been pretty fast in the last few months. There are no more checks to be had, of course, and now rates are rising, and so actually borrowing to sustain any kind of spending just doesn't make any sense in an environment of rising rates. Obviously, there's a wealth hit. Obviously, you've had more households be involved in the equity market and crypto, and kind of, the stocks have been popular with households than in prior rounds. And so households have actually shifted from a situation where every month they were able to put away a lot of savings, so their balance sheets healed, to needing to spend that down. And I think they're just less likely to keep doing that in an environment where rates are rising.
Which then raises the question, what kind of recession then do you think we see? So just as an example, I'm just looking at small caps for a second, the RTY. typically if we're going to get into a recession, those get hit super hard, and that already was the case so far this year. But they have stabilized and rallied 7% in just like a week, which tells me, and many analysts are saying, like, all right, we priced in the bad news, we can kind of move on. What kind of recession do you think the market's going to have to contend with?
I think the biggest thing the market hasn't contended with in terms of stock pricing, because we haven't experienced it since the 1970s, is we have to really think about what kinds of companies are going to be able to pass on the inflation to households and which companies are not going to be able to do that. So when you go back at the 70s, you basically see, first of all, the entire stock market gets a higher risk premium because it is simply harder to run the cycle in a predictable way with more volatile inflation. That hasn't been priced in yet. And that's true for every company. But then in terms of types of companies, you see huge differentiation in the 70s between who can really pass on the cost increases to households and can keep their margins, and whose margins get very, very squeezed. And that's a factor that was very high on people's minds when looking at individual companies back then. And stock analysts just haven't had to think about in 40 years. And so we've been very focused on doing that research and trying to understand what kind of companies are going to be able to pass that on. And I'll just say, across the whole market, you're talking about this quick recovery, there's just not much that has been priced in so far in terms of any companies having a severe recession in any of the cash flows that they're getting. There's not much of a recession priced in yet.
But where does that research lead you? We don't have to get names, but in terms of sectors then, that are a little more resilient, that show that resilience. I know you're saying that across the board that hasn't been priced in terms of the recessionary impact, but which sectors are the most sustainable within this environment?
I mean, look, I feel like I've talked too many times about how much I love commodity producers, and even though that's not the single most, you can also look at people that aren't literally involved in commodity production, but commodity producers are just the most direct, extreme play of exposure to inflation pressures that investors can have.
But sorry, Karen, into a recession, commodities, that trade still makes sense, into a recession.
Well, obviously they're cyclical, and commodities were a lot more attractive when you knew in the beginning of the year what's going to happen is that you're going to have strong nominal growth. The thing you knew going into this year is you didn't know if it was inflation or if it was growth. You were just going to have strong nominal growth. You knew you wanted anything exposed to that, and commodities were the best possible play. Today, growth is clearly slowing, and so on one hand, commodities are significantly more cyclical. On the other, most investors just don't have almost any inflation protection, and so while they're significantly less attractive than they were, it's still better to have some inflation protection than otherwise. Investors also don't have any gold and so on. And then once you get into individual companies, I don't want to get into specific names, but you definitely see already kind of what the worst are. You can see already where you have companies like retailers already telling you, I can't pass this on. My margins are too small. My houses are getting hit too quickly. I know I just can't pass this on. And so you can already see, I think, in company comments, some differentiation of who's consumer facing, which consumers can handle it and which can't. And then if you're stepping back and saying, I have no inflation protection, I think you want some commodities.
Karen, last question. If you were in the presser with Jay Powell today, what would be your question to him?
I think I'd be really interested in how Jay Powell is processing the dollar and currencies more generally. It's something the Fed doesn't love speaking about, but they have to be looking at and thinking about and trying to understand the knock-on effects to other parts of the world. And I also think I might ask him about how he thinks about food prices and their impact on, kind of globally. But I think I also listed more broadly where I think that the market is miscalculating what they're going to do. So I might also be direct and say, hey, don't you think you want to speak about the fact that you're not likely to be using so soon? And see what he says.
Okay, Carrie and Carney Damble of Bridgewater, thank you very much there. The questions for Jay Powell, of course, the presser, that rate decision coming up, followed by the presser, and of course the view there from Bridgewater that these equity markets have not yet fully priced in the potential recessionary environment. Coming up, what is the impact then of rising inflation on credit card spending? We discuss with the CFO at Visa in an exclusive interview. This is Bloomberg.
Looking for another rate hike today.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
Visa sees no evidence of a pullback in consumer spending despite that surging inflation. Now, the company beat in earnings in the second quarter. Transactions were also up 16%. The stock is also up as well. I spoke with Visa's CFO, Vasant Prabhu, in an exclusive interview.
There have been quite a few changes in how people are spending money. You know, overall, the consumer is spending as they were. In fact, if you look at our numbers through most of this year, consumer spending has been remarkably stable, especially when you compare it to 2019, which is a clean look because comparing to last year has a lot of noise in it. But there are differences. Consumers are moving from buying goods to services. Consumers are changing from buying things they want for the home improvement and, you know, apparel and so on, to experiences. So, you know, they've been stuck at home for so long, they're very eager, as you've heard, to travel. Yeah. To go to restaurants for entertainment. We're seeing significant growth in those areas.
Well, what's your visibility for how long that's going to continue for?
Well, as we like to say, we are not leading indicators in that I don't know, for example, that you may not be feeling confident and may not buy something a couple of weeks from now. I only know that when that happens. So the only part of our business where we get to see a little further out is in travel bookings. And they've been holding up fairly well. But that's only 30 or 60 days out. Now, clearly the prices have gone up, so spending levels go up with prices. But in general, travel bookings looking out have looked quite stable, quite strong, even in the last few weeks.
In terms of, say, then the inflationary impact, what have you noticed and how has that impacted the consumer?
Well, the exact impact of inflation is hard to tease out from the numbers right now because there's so many things going on. You know, so for example, you know, there's shifts in spending going on that affects what people buy. And what we get to see is how much people spend at a particular store or a hotel or whatever. We don't get to see exactly what they spend. So, you know, what we get to see is, are they spending the same as they were before? And they generally are. But under that, if they are switching, you know, from sort of a brand to a private label,
you can't see that part.
You know, we don't see that. And so like Walmart the other day, you know, had a profit warning, but their sales were up. They said their sales were not affected. And that's what we see. So our business with them probably wouldn't be affected much. But what they're seeing under that, of course, is people are buying lower margin items, they said, and they had some excess inventory in some areas. That doesn't affect us. So as long, you know, we're not sensitive to where people spend or what they spend on. We're only sensitive to how much they spend in total. And as long as they use Visa cards, which they are.
Are people having any deferred payments? Are people defaulting more? Do you have to put more aside for that?
Well, you know, we're not the bank providing the loans, the credit. Our partners, the banks who issue our credit cards, are the ones who do that. So they would be better equipped to answer that question. But from what we're seeing...
but you would see late fees, that kind of thing?
Yeah, there's no evidence of stress, so to speak, on that front.
In terms of Visa's individual business, many technologies are looking at hiring freezes and even layoffs. Are you seeing any of that? Are you thinking about it? What's your visibility?
From our standpoint, you know, we have a business we think is quite resilient. We have a business with some great growth potential. We're investing in a variety of new areas. We have a business where we call our new flows business, where we're investing in a variety of new ways to pay. We have our services business, we call our value-added services business. So from our standpoint, we remain in a mode where we're very vigilant about any changes in trend, but there's tremendous opportunities. I would say in general around tech, yes, there's been a lot in the press about people slowing down hiring and so on. I would tell you it's still early days. I still hear from our human resources people that, demand is still very strong for people. There's a lot of jobs out there, but that could change.
So on that same point, we've seen a lot of decline in valuations, say in fintech and other tech valuations. Does that provide any opportunity or strategic M&A? And if so, where?
Sure. M&A for us is geared towards capabilities and businesses that we may want to be in, things that are faster and cheaper for us to buy rather than to build. We stayed very disciplined when valuations were bubbly. We thought they were bubbly. If things are coming back to reasonable valuations, certainly there's more opportunity for us.
Where's the hole that you would need to fill?
Well, we have, a value-added services business where we sell a variety of services that layer on top of our core payments business. And we're always extending capabilities there. We just bought a company called Tink in Europe that does open banking. We bought another company in London called Currency Cloud that offers real-time exchange rate services. So we've bought a few companies over the years that extend our capabilities into fraud, into risk management, into making it easy for people to connect to our network and so on. So it's about extending the services we can offer. It's about making it easy for people to access our network. It's about adding additional value on top of the core services we provide. So those are the areas we would look at.
That was Vasant Prabhu, a Visa CFO. And Tom, this just goes to the conversation we were just having with Karen. If you can pass on higher costs, the spending from the consumer is okay. They're just changing what they put their money into. And for a name like Visa, so far, that's okay. He has no visibility in terms of any trade down, say if you spend money at Walmart, but they're still spending the same amount.
I think it's fascinating following those trends within the consumer. As you say, we're seeing that within the luxury space here in Europe as well. That high end, that premium is still holding up. Of course, there's that divergence, that split between those households that have the cash and those that don't. And so that is going to inform these themes as well going forward. But a fascinating insight there from the CFO of Visa. We have plenty more coming up. Of course, your markets here in Europe, currently you're looking at gains of around 0.7%. The strongest gains over in Italy. FTSE Mid currently up 1.5%. Stay with us. This is Bloomberg.
And Gordon.
Coming up, we will look at the Fed's impact on emerging markets. Mark Mobius, Mobius Capital founding partner, is next with all of his experience and insights when it comes to EM. Stay with us. This is Bloomberg.
All right, we're an hour into U.S. trading session. We do have some movement here. The Nasdaq's really outperforming. The Nasdaq 100 up by almost 2.5%. Bloomberg's Kriti Gupta is here with all the moves. Kriti?
Yeah, Alex, it's a defensive lead very clearly. That outperformance, that really wasn't the case yesterday where you saw the Nasdaq actually dragging down, I would say, all the benchmarks, really, that tech-heavy Nasdaq. Well, today it's the flip. The idea here that you do see a little bit of a broad rally. Tech out in front. Alphabet and Microsoft earnings really helping that story. But take a look at this. You also see a slightly weaker dollar today that's probably adding to a little bit of the gains. And on top of that, the 10-year yield, 276, those yields lower. So any worries there about the yield story impacting the tech story, that does not apply today, at least with yields down about 4 basis points. But let's dive into tech just a little bit more to just show you just how fast and just how furious the rally really is. Take a look at this. Microsoft shares up almost 5%. The idea here is huge. The idea is that if you have the biggest, the fastest growing companies in the S&P 500, essentially your mega cap tech, and they're the ones that are able to actually weather a recession, weather some of these macroeconomic headwinds, well, then there's hope for the rest of the S&P 500. At least that seems to be the story from Microsoft, from Alphabet as well. That's really kind of been shielded to some extent from those social media ad headwinds, I should say. Texas Instruments also holding a strong 5%, leading, by the way, all the semiconductor space. That's going to be significant. And PayPal up to the tune of about 8% as well. Let's talk about the main event today, though, and that is the Federal Reserve. That decision coming out at 2 o'clock, the presser about 30 minutes later. 75 basis points priced into the market. This is also going to be perhaps a little bit of importance because of the pattern that we see on Fed days. The idea here is that from 2 to 4, you do start to see a rally, or we have seen a rally in the past couple of Fed meetings. And the day before the Fed, we tend to see this massive pullback in anticipation. That is the exact trend that we are seeing this week. Let's see, though, if the rally continues and holds until 4 o'clock, or if the Federal Reserve does indeed surprise us. That's going to be a key part of the equation. At the end of the day, it's not just the Federal Reserve. The action doesn't stop there. We do get one more big tech earning after the bell, and that, of course, is Meta. A lot of that has to do with revenue, with year-over-year revenue, and whether or not social media can actually hold steady through what may already be a recession that's in play, Tom.
Yeah, the earnings of Twitter and Snap feel like a lifetime away, don't they, in this context? Kriti Gupta, fantastic stuff. Thank you very much indeed. Let's get back then to the Fed. As Kriti mentioned, of course, Chair Jerome Powell is set to deliver the largest back-to-back increase in decades today. The central bank is expected to raise interest rates by 75 basis points for a second straight meeting. Joining us now for more is Mark Mobius, Mobius Capital founding partner and an expert on all things EM in particular. Mark, thank you for joining us today. Let's start then with your view, the debate as to whether or not the Fed ends up pivoting or keeping the bit between its teeth when it comes to inflation, even amid some potentially softer eco data. Does it charge ahead to its 2% target, or does it pivot in the face of weaker data?
I think they're going to have to keep on raising because at the end of the day, the playbook is that they have to have interest rates that are higher than the inflation rate in order to beat inflation. That's the playbook. And with inflation now at 9%, that means they've got a long way to go. So I don't see how they can let up without really going against what they've been thinking for so long. So I think it's going to be a big raise going forward.
Mark, it's great to see you, by the way. The market is not looking for that at the moment. The rhetoric is definitely there, but the price action tells us a different story. Cuts sooner than we think. The Fed can't go as hard as they want because of the slowing economy. When you take a look at asset prices, what asset price has the best chance of re-rating if the Fed still goes hard?
If the Fed goes higher, then the assets that have no debt are the ones that will really be performing. Because as the rates go up, you're going to separate the men from the boys in the sense that those companies that are in debt are going to get in deeper and deeper trouble. And those are the companies that are going to be underperforming. So you've got to keep your eye on those balance sheets and, of course, the Fed hiking, which I think they will continue to do.
Mark, what about the balance sheets of countries and governments around the world in the face of a more aggressive Federal Reserve and a stronger US dollar? What is the vulnerability there?
Mark, can you hear us?
Yes,
I
think
may have some... Sorry, Mark, go ahead. I think we had a bit of a glitch there, but go ahead.
The U.S. dollar, I think, is going to continue to be strong, simply because globally people are afraid of higher interest rates and declining markets. The pessimism is pretty great out there, and of course the haven is the U.S. dollar. So the combination of safety, desire for safety, plus higher rates means that the dollar will continue to be strong and maybe even get stronger.
And Mark, we've seen emerging market central banks having to respond by hiking a lot, very significantly large hikes to sort of combat that. How can you be invested in emerging markets right now? What's the case?
Again, well, as I said, we have to go after companies that have no debt or very, very little debt, and companies that still have a business model that will allow them to raise prices. Because in all countries around the world, you have inflationary pressures. So prices are going up on the supply side, and you're going to have to match that if you're a company. And of course, those are the companies that are able to do that are the ones that will survive.
Mark, just turning our attention to China and the role that China historically played, at least 2008, 2009, with that massive stimulus that, of course, had the rewards for the rest of the world in terms of returning the global picture on stronger growth. On the back of that stimulus, can the Chinese do it again, or is the change in sentiment amongst the leadership in Beijing holding them back from that kind of aggressive stimulus?
I think it's going to be very difficult for them to do it. Of course, they're going to try. They've been lowering rates But the property sector is really the problem in China today. They've got to bail out these property developers that are bankrupt, basically, and the banks that have lent so much money to these property developers. So I can see more problems ahead. And of course, you must remember consumer sentiment is very, very strong when it comes to property in China. Chinese save by buying property, buying apartments. And with apartment prices going down, or at least not going up dramatically, and with all the defaults, then you can have real problems.
Mark, on a fundamental demand basis for China, Bloomberg sat down with Rio Tinto's CEO earlier, and he talked about what he's noticing about China demand from his seat. Here's what he had to say.
And it's always difficult to say how long time will it take that the Chinese economy is being stimulated, and that means that more growth will come in the second half. Is it next month, or is it 3 months or 6 months down the road? It's always difficult to say. I try to avoid predict the very short term. I'm not sure anyone is capable of doing it. But we remain convinced that the Chinese have got the measures and the desire to stimulate their economy.
Mark, I can see you disagreeing with that, and clearly you're going to have Rio Tinto talk in his book, but nonetheless, what are your thoughts?
Well, I think there's no question the government is going to be in control of the economy as they have had before, and they're going to simulate it, and they're going to make sure that these companies are bailed out. But it's going to be difficult. It's not going to be easy, and I don't think we can expect the kind of growth rates that we've seen in the past with China. It's a bigger base, of course, so it's more difficult. But also, as I said, the debt levels are so high, it can be a real problem.
So, Mark, what does that mean then for the commodity cycle that we're looking at?
Yeah, I think you're in a situation now where many of these companies will be in a down cycle and will be in real trouble. And of course, as you know, many of these property companies are bust. The game is over for them.
Mark, I get that point if you look at the demand side of the commodity world, but the supply side does feel like we're in kind of a structural shift rather than a cyclical shift due to the energy transition and due to ESG. Are there any parts of the commodity sector that you think can be better, and the war in Ukraine, by the way, that can withstand a slowdown?
No, I think the commodities sector has already had its run, and you can see most of these commodities have corrected down, including oil. You can see oil's come down, platinum, palladium, gold, etc. So it's already had its run. And of course, this is a reflection of demand. At the end of the day, consumer demand will drive these commodity prices. So we don't expect very much more in terms of these commodity prices. Of course, inflation has played a role, because if you have a devalued currency, it looks like prices are going up. But at the end of the day, it comes down to consumer demand, and we don't think it's going to be there to push prices up very much.
Mark, on the question of gas and gas to Europe in particular, of course, from Russia, we've seen 3 straight days of very solid gains in terms of gas pricing over in the Netherlands. To what extent is the shock around gas priced in to assets, equity markets in particular, here in Europe, as we weigh up the very real possibility, it seems right now, of Vladimir Putin cutting off gas supplies altogether?
It's a real concern. I happen to be here in Amsterdam, and you see a lot of bicycles being used rather than cars. But at the end of the day, people are very concerned about the coming winter and what it will mean for being able to heat homes. Already they're cutting down on the use of air conditioning and other uses of electricity generally. So yes, it's a big concern.
Mark, before we let you go, I know you mentioned kind of the type of companies that you're looking for with low debt. I just want to get your quick take before we go. What region is that bet most placed in?
I would say right now in the tech sector, you have a real dichotomy with companies that are in deep trouble with no earnings and high debts. Those will go by the by. They will go down. But then you have some tech companies that are very rich in cash, have a good product cycle, and good earnings momentum. So I think those are the companies that we want to look at.
Hey, Mark, it's always good to see you. Thank you so very much. We appreciate it. Mark Mobius, Mobius Capital founding partner. Great to have you on to the day like today. Coming up, Rockwell Automation shares are up after posting quarterly earnings that did beat analyst estimates. It's one of the top performing stocks within the S&P. We're going to talk to Chairman and CEO Blake Moret joining us next. This is Bloomberg.
Now is Bloomberg. Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. President Biden will speak with China's Xi Jinping on Thursday. The call will take place at a difficult juncture for U.S.-China relations. House Speaker Nancy Pelosi's staff has not ruled out that she will visit Taiwan next month. China has warned against the trip. Beijing considers Taiwan part of its territory. Bloomberg's learned that the Justice Department is using grand jury to investigate efforts by former President Trump and his aides to overturn the election. The focus in on creating fake electors and pressuring former Vice President Mike Pence to refuse to certify the Biden victory. No comment yet from the Trump camp. And grain exports from Ukraine could resume within a week and reach 25 million tons by the end of the year. That's according to Turkey, which brokered a deal between Ukraine and Russia that eased fears of a global food crisis. The United Nations expects the first ship could leave a Ukrainian port in a few days. Global news 24 hours a day. Thursday on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Alex?
Thanks so much, Angel. Let's focus on Rockwell Automation. It's the fourth best performing stock within the S&P today. It had earnings that beat analyst estimates. The stock is actually up now almost more in a year. Joining us now from more is Blake Moret, Rockwell Automation Chairman and CEO. Blake, super solid numbers. Stock obviously reacting in kind, but I did wonder if you could help us tease out some of the recessionary fears. Where may you see cracks? What signs do you look at in terms of a global recession warning?
Sure. Well, let's start with the backdrop. We have over $5 billion of backlog, which is far higher than at any point in our history, quite frankly. And orders continue to beat our expectations. So, very solid demand across industries, regions, and our businesses. But we do see inflationary pressure, chip shortages affect us, affect our customers. And I would start with the businesses that are closest to the consumer. So e-commerce, we've seen a little bit of a slowing in demand there. In other aspects of warehouse automation, people are making expenditures to increase their productivity. But I would start closest to the consumer, where you'll see the first effects, I think.
Yeah, Blake, that's really interesting kind of granularity on where you're seeing some of the strain in terms of inflation supply chains. You posted orders, you saw orders up 17% year on year. As you look ahead and extrapolate out to the second half then, and bear in mind what you just said, do you see orders holding up at those kind of levels as we edge towards the end of the year?
So orders, and just to put that in even more perspective, I mean, that's over 40% above pre-pandemic levels. So we're going to have over $10 billion in orders this year. So it continues very strong. As lead times hopefully start to come in terms of what we can offer our customers, then we'll see the size of some of those orders probably reduced, particularly among machinery builders who, because of the long lead times, have had to place larger orders to cover the amount of backlog that they have in terms of their machines. And so that's going to be a healthy thing. As lead times start coming in, they're not going to have to place orders to cover as many months of required equipment for them to be able to complete and ship their machinery. So we would see that as a natural development as orders and shipment levels start to converge. But the low cancellation rates that we continue to see indicate that the underlying demand remains really strong there.
That's interesting. So it's not necessarily indicative of anything negative, just sort of a renormalization of order flow. I'm wondering if you could give us some insight into the semi-manufacturers. They've been out with some cautious spending outlooks. We're kind of learning that the semi world is actually cyclical and we're not in like a structural shift. Are you seeing any signs of a pullback there?
So, I think the semiconductor industry needs to add capacity. They need to add it for the leading edge process nodes, the newer technologies that go into handsets and communications and so on. But they also need to add capacity for the so-called legacy nodes, which is what industrial companies use, as well as a lot of the automobile technology, the onboard technology requires that as well. And so we're going to see the continued emphasis on capacity expansion because the world is trying to make everything smarter, and we certainly see it in our products, but also in our customers' products as well. So I see the semiconductor industry continuing to expand. They're obviously going to make certain decisions about where they put that investment and the pace, but in general, we're going to see far higher amounts of semiconductor industry spending for both the fabs as well as the capital equipment that's required in those fabs than we've seen for some time.
And Blake, just more generally then on that point, when do you see those supply chain constraints, including semis, start to get to kind of pre-pandemic levels or to normalize?
It's going to take a little while. We certainly see a gradual improvement. That was part of the contributor to our success in the third quarter, as we have, enormous demand, and we'll continue to have that demand in terms of backlog and orders to be able to fulfill over the coming quarters. There'll be gradual improvement. We do see some additional capacity for the types of technology that we use coming online even in calendar year 2022, with additional capacity coming online in 2023 and beyond. Fundamentally, what we can do to address our chip shortages are making sure we have the best possible relationships with our existing suppliers, making sure that they remain committed to the industrial space and that they are adding capacity to meet our demands. And then third, for the most severe bottlenecks, for us to redesign around those most severe pinch points.
Valuations, like all across the board, have really come down. Maybe today is a bit of an exception. And I'm wondering if there are any holes in your portfolio where you feel like you might want to fill with M&A. I mean, you guys are so good at being concentrated, unlike some of the bigger diversifieds like a Siemens or GE. But are you wanting to add on anywhere?
So we are very proud of being a pure play and that we can focus all of our efforts on industrial automation and digital transformation. We think that contributes to our growth as well as our profitability, quite frankly. We continue to have a robust funnel for potential acquisitions, and we've developed a well-established and visible priority list of the things that are most interesting to us. Valuations have come in a little bit, but interest rates have gone up as well. And so, we continue to be selective, first looking at the strategic fit and then looking at meeting our financial hurdles.
Blake, just briefly before we let you go, what do you see in terms of the trend for pricing? Are you getting any pushback from your customers around higher prices?
Well, we have had substantial price increases over the last year, several different increases to meet the pressure on our own costs. And we're seeing very high realization. Customers understand what we're going through. We're in a very differentiated space in terms of what they need to run their operations. And so we're seeing good realization as in terms of what customers have come back with in terms of acceptance of the price increases that we've announced here recently.
Okay, Blake Moret, great insights after a strong set of earnings. That company stock up currently at 7.3%. Rockwell Automation Chairman and CEO. Thank you. This is Bloomberg. Welcome back. We're seeing gains of around 0.5% across the benchmark here in Europe. Investors taking some solace from the earnings that have come through, but of course the focus as well on that decision from the Federal Reserve later today. The Italian 10-year currently yields up 7 basis points at 3.32 after S&P lowered their rating on that country on the back of political risk. Gas prices up again for the third straight day, gains of more than 30% over 3 days, currently up 5.5%. And the challenge around Europe, of course, Goldman Sachs telling us earlier they now see a base case, a recession in Europe. Coming up on the European close, Mike Sievert, T-Mobile CEO, will talk the earnings results, of course, from that telecom giant in the show. Stay with us. This is Bloomberg. It is Wednesday, the 27th of July. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Okay, it's the Fed, it's earnings, the two factors really driving the moves in these equity markets, and some relief taken from investors here in Europe around the earnings picture, particularly within the banking sector. If you strip out Credit Suisse, UniCredit performing very well indeed. Gains of 0.5% then across the European benchmark as we head towards the close.